Welcome everyone. Again, Emmanuel Lyson coming to you today with another edition of Financial Breakthrough Academy. I'm your host, Emmanuel Lyson, your certified financial educator. We have a wonderful lineup of content for you today that will really help you, your family, and your business. You have heard us talk about the need for us to be educated financially, understand the concept and the various nuances when it comes to finance. We have to be equipped, especially for those of us who are believers who trust in God for His blessing. It is important that we know how these blessings are translated from the spiritual realms to the physical realm by understanding concept, by seeking wisdom and knowledge and insight to be able to experience the fullness of the blessing of God in the area of finance. So today I want us to look on the subject that many of us may not have taken attention to. We will be discussing basically the subject of Tax Cut and Job Act. It's a two-part series today. I'm going to start off with the first portion of it. Um, Most of us never really, we don't ever, maybe feel directly impacted by some of these changes, but they do impact us. Last December, we found a new Tax Cut and Job Act together to replace what was in place already. And my education session today is designed to provide some very basic overview and content that will enable you to understand what this means to you as an individual or as a business owner. This first part will focus on individuals, how it impacts us as individuals, and then we'll come back on the next section and talk about the impact of this new Tax Cuts and Job Act on businesses. But before we go forward, I want to just preface here that the content here is not to be taken for tax advice. This is not tax advice. It is important to sit down with a tax professional, financial advisor, who has the credentials to be able to deal with taxes in terms of being a tax advisor in that case to really see how these changes impact you as an individual or as a business. You do not take the content just for tax advice to implement it. You sit down with a tax professional to be able to see how it impacts you in that direction. With that said, let us take first of all, again, there is two aspects to what I'll be dealing with. The first will be on in how it impacts us as individuals, and also the next section will deal with the impact of the changes on businesses. My focus today will be on the impact on individuals, the tax reform and how it impacts individuals. So let's get on to the main crux of the content today. There are basically three aspects of the changes that impact individuals. There are the changes in the tax bracket itself. There is the changes in the various deductions that occurs, and there is also the changes in the tax credit. So these are the three main aspects that the changes in the Tax Cuts and Job Act will affect individuals. Again, like I said, I want us to focus mainly today on how the changes affect individuals, but also there is a very big component that affect businesses, and we'll treat that during our next session. So let's go ahead and look at some of the big changes. So again, there are three main aspects I'm trying to focus here. How does the changes impact the tax bracket? How does it impact deductions, and how it impacts tax credit? Okay, so let's look at some of the changes in essence for the area of the tax bracket. I believe that this would be the most valuable portion for most of us. So we all understand that when we make money, there is a portion of it that goes to the government in form of taxes. For us who are believers, we understand that that is biblical. It's okay. Jesus answered in a very interesting conversation, and he said, "Give unto Caesar what belongs to Caesar, give and unto God what belongs to God." So it's okay to be able to pay what our fair due is in taxes. The ideal situation, we do not avoid paying taxes. However, we just want to be able to pay what is reasonable. So for us, we are concerned based on our income level. We have to maximize the tax efficiency strategies we have so we don't avoid taxes. So here we are. These are the various brackets that have been put in place as of now, effective 2018. As you see on the screen here, the income level determines what your ordinary income bracket is. Now, I have two aspects, what the former bracket is and what the current bracket is. So, to begin off the top, from 0 through to $19,050, the ordinary income tax bracket is pegged at 10%. Again, formerly it was still around 10%. From there, we have the bracket between $19,051 to $77,400 pegged at 12% income tax bracket. So majority of middle class will probably be falling in somewhere in the second level of that. Formerly, that was bracket was 15%. The next is from $77,101 all the way to $165,000. The bracket is at 22% currently. It used to be at 25. And then you move on to the next from 165,001 all the way to $315,000. That's about 24%, down from 28. And then you have the bracket from $315,001 all the way to $400,000, moving down from 33% formerly to now 32%. A dollar more of that to $400,001 all the way to $600,000 is staying the same at 35% from how it used to be formerly. And then anything a dollar above that amount is pegged at 37%, which is down a couple of points, 39.6 formally, and now to the highest end tax bracket in the country. So these are what we know of as the main changes that may affect most of us when it comes to the tax change that has occurred. In fact, ideally, we should say that these changes are to our advantage for most people. There is majority in terms of the actual bracket. Most people are favorably impacted. There is slight decline in the tax bracket for majority of income earners. So that is something to really be thankful for, and therefore something to think about. How do you plan when you are dealing with financial planning? This changes brings to the bear when you talk about financial planning. How do you make efficient use of this advantage of the tax bracket going down? Because the fact is that whereas our ordinary income tax bracket may have declined, there may be circumstances where some other assets you have may be said that it might necessitate you perhaps looking at how you make use of those assets just to make sure that you are staying in the right tax bracket. And again, it's vital to sit down with a professional to be able to do a thorough analysis to see how you can tap into some of the other assets you have depending on its tax, I would say, structure, whether it's tax favorable or not. There are certain assets that may not be so favorable when you tax, so it's structure of taxation. For those of us who may be getting into retirement time, you may want to consider how these changes may impact you when it comes to how your income is now coming out, and some of your sources of income, whether it's social security or other qualified plans or gains you may have that may impact your total tax bracket when it comes to your withdrawals and all that. So in general, this is basically what we have now, and I believe that it's a good thing, and the savings we are receiving from these reductions should enable us to perhaps put some more money away in a process, rather than just spend it. We've talked about some of these over some of our series about how there are three main ways we use money, whether we spend it on basic necessities which we all need, or we may want to save some for medium term emergency needs, and most importantly also sow or invest some for the future. So this is the general changes that has happened when it comes to the tax bracket, and it's important for us to take note of it so we can know how we can adapt ourselves and our various assets, whether it's coming from our regular income, investment assets we have, or any other kind of assets to enable us to maximize the tax efficiency of our resources. Okay, now here is the other aspect of the change that may be important to some of us. It's in the area of capital gain tax bracket. Capital gain is basically gains that come from investments, whether it's stocks, dividend from stocks, or other interest earned from investment. That is what capital gains are. Now, it's very, very important we understand that not every type of revenue or income or resource is taxed equally. If you see here, the bracket in the tax for capital gains are as follows. Anyone whose income is between $0 to $77,200, the capital gain tax bracket is 0%. Okay, and beyond that, 77,201 all the way to 479,000, the capital gain bracket is now at 15%. A dollar more than that, at 479,001, the capital gain tax bracket is at 20%. Now, if you look very carefully, these brackets seem to slightly lower if you compare it to the ordinary income tax bracket. This demonstrates and shows why a lot of people who desire to have financial wealth tend to invest a lot in assets that may be classified, when the gain comes at capital gain, because you realize that the tax bracket there is much lower. Okay, the Warren Buffetts and the others that learn from them tend to have lower effective tax bracket in the long run. So depending on where we are in our own journey financially, it is important that we learn some of these concepts so that as time goes on, as we increase in our revenue potential and our assets and our various resources financially, we understand how to position our resources to experience or receive the most efficient tax treatment. The most efficient tax treatment. That is why it's important that we all learn how to invest and to sow and to take reasonable risk. Again, investment is very risky. There is no investment that has no risk. Every investment has some risks. However, over time, as we grow and improve and mature in our financial journey, we come to a place where we are able to maximize the tax efficiency of our resources, because at the end of the day, that is an important element to consider. So that is the second aspect of the tax bracket that concerns the capital gain. So if you have any kind of investment that is treated as a capital gain, these are the new brackets for them. And if you sit down with your tax professional or a financial advisor that is helping you plan, you may be able to now understand how these work and how you can have most out of your resources that you work so hard to get. One key element is that there is no more what we call the concept of exemptions. I think that for the most part, when we submit our 1099s or other tax documentations to our CPA or registered professional who's doing the taxes, we just send our document and let them handle that. But it's important to understand that the idea of exemptions have been done with within the new law that has been put in place. So there are no more exemptions. The thing is that the exemptions has literally been replaced in a way by the increase in the various deductions that is now in place, and we talk about it at some time. Okay, next is what we call the various credits that are now in place. The new law has these credits that are in place, including health care tax credit is being put in place, and income credit, tax credit. There's been some adjustment to that to reflect what is needed. There's educational credit, there are savers credit, there's a child credit increase to 2,000 for kids 70 years or less. That's it. Most of us, perhaps, who have children, that's the kind of credit that helps us in terms of when we are doing filing. Okay, there is also what we call the other dependent credit. If you have some other person that is in the household that depends on you, perhaps an elderly person or something like that, there's that dependent, or anybody that qualifies as a dependent, depending or according to the tax code, there's a $500 per qualified dependent as well. We have also what we call the additional deduction for the 65 years and above. The seniors have each $1,300 additional deduction here for the credit for them. So we have, again, these are the various credits that is also in place now. We don't need to know details. Our various CPAs and tax professionals will handle that when we go to prepare our taxes. However, it's important to know the kind of changes that has taken place in that direction. Okay. Next is what we call the deductions, exceptions, and credit, which I just mentioned, the area of credit. Now, the deductions and exceptions, here are the main differences. When we talk about deductions and exemptions, they are designed to reduce your taxable income. Okay, so if you have any kind of deductions or we have exemptions, which we know is pretty much non-existent, the definition here is that those deductions are designed to reduce your taxable income. So you may have an annual income of about, say, $100,000, but depending on the kind of deductions you have, let's say you're a business owner or something, you have some items you write off as deductions, it ends up reducing your actual taxable income. In other words, the income that is subject to taxes. Okay. However, credits are designed to directly reduce your taxes. So if you have a child and you have a child credit, that is designed to reduce your tax liability directly. If there is a health care credit that you receive, that is also designed to reduce your taxes directly. So some of the various credit we mentioned earlier on, those kinds of credit that reduces your taxes directly. Deductions are designed to reduce the taxable income, the portion of your income that is subject to tax, whereas credits will go directly to reduce your tax liability. So that's the two differences when we talk about the deductions and then the credit, how it's treated. Okay, so these are the other part. The one I want to address again is, again, I'm focusing specifically on the changes and how it affects individuals. So let's look at deductions, for example. In the area of deductions, here are some of the changes that we have to note. Now, the standard deductions have been pegged at $24,000 for married couples. Okay, so we have $24,000 for married couples as the new standard deduction. The head of household pegged at $18,000, and then singles their deductions have been pegged at $12,000. So that's something to note here. So depending on whatever your income is, this is how the deductions will occur. Remember, whenever you're doing taxes, or your accountant or your CPA or enrolled agent is doing your taxes, you have one or two ways when it comes to deductions. You can either do a standard deduction or you itemize. In other words, you just list all your various qualified expenses or the various things that is allowed as a deduction. So when you are not itemizing, you are just doing a standard deduction. Here are again, what is now the standard deduction for couples, 24,000, for head of household, 18,000, for singles, 12,000. Okay, so married 4,000, head of household 18,000, and then singles 12,000. When it comes to itemized on the other side of the chart in here, the changes for the itemized deductions. One is the fact that mortgage interest on up to $750,000 of acquisition, not included HELOC, is now what the level is. It used to be even more, I think $1 million or so. It's now been capped down slightly. So mortgage interest on debt, that is for acquisition. In other words, if you buy a property or something like that, not including HELOC, that is what the peg is. That's HELOC is home equity line of credit, pretty much. Okay. Now the next deduction in itemized section is a charitable gift, whether of cash or check, is now pegged at 60% of income. That is the maximum that's allowed here in terms of itemized deduction. Now, state and local property tax is now pegged max at $10,000. So these are some of the deductions that will impact individuals when it comes to the taxes for the year 2018 and going forward. Okay. Now the section on 199A deduction pass-through income, I will treat that in the next series I will be working on for us, because that specifically deals with business owners. And like I said, I'm treating this in two parts: individuals and businesses. So that will be for our next session when we do the pass-through 199A deductions. Here are a few resources that if you want to read up on your own, you can go to the irs.gov, and the link up there, the tax reform, you can read up, or you can go to US Congress as well, the link up on the screen. Or there are a couple of articles that are also very, very useful. One on Forbes, another one on a company called Pegasus, and there's an article that I have been using on eMoney Advisor for my clients here that talks about the tax cut and the Job Act. For those who want to read up on their own, these are some references from the changes. So very much, I would say that here are the main things that I wanted to share today. Just give us a brief overview of some of the changes that has happened. Again, we are not supposed to necessarily be expert in these changes. However, we should be cognizant of what is in place now and how it affects us when we are planning. We do our financial planning for our families, and looking forward, to some of the impact they have on our day-to-day financial planning. I will wrap up here today. If you want to have more information, you're welcome to contact us 720-588-9717, or go online to licensconsultant.com/financial planning, and you can start a process with us. We are always open to come to local assemblies, organizations, churches, to come and provide content of this nature, informational content, to help our community be educated, be informed, so we can be able to continue to build ourselves up, especially for those of us who are believers in Christ and wanting to do good in the community. We want to be financially sound so we can contribute positively to the development of our communities and our people. With that said, this has been Emmanuel Eisen, your financial educator here, coming to you for another edition of Financial Breakthrough Academy. Have a wonderful rest of the day. We'll be back very soon. Thank you.